So the most important thing is to master the right money mindset. Before you even touch money, before you even buy anything, before you even invest anywhere, you gotta have the right mindset. This is composed of 3 key principles that I found out myself. 1, you need to establish money is a tool. No one wants money just to have money, just to get a big sack of money and just lie around in money.
Pennies to dollars, any amount will do. Cha-ching, cha-ching, it's no contest. There's only one thing that I love the best.
No, you buy money because of things it can get you. Keep that mindset with you throughout life. And it's important to know that and to keep that mindset, because if you see money as something to have rather as something to use, you'll find yourself working and working and working and working and never even using your money for what you intended in the first place. You become a slave to whatever job you're doing, if you're only doing the job for the money. So it's important to establish that mindset. Now, next, you need to make more than you spend. That sounds obvious, right? But obviously it's not, because many people are in debt, which is what happens when you're spending more than you make. Make sure whatever is going out is coming in plus some more. 3, you need to know that money can work for you. Right now, we're usually taught that we work for money. You get a job, you put in the hours, you get your money out. But it's important to know that money can work for you. This is called passive income. Passive income is really where you put in the work up front so that you get money later on without having to put any work after. Quick recap. Money is a tool. Make more than you spend, and the money can work for you. Next, we're going to be talking about managing money. I want to establish this very important point. If you don't know how to work with $10, you won't be able to know how to work with $10,000. Making more will not make you better at managing money, because those are 2 different things, 2 separate skills. Number 1 important step to managing your money is tracking your expenses. So you want to take maybe a month to observing what you purchased. So you want to save your receipts, you want to keep your credit card statements, and at the end of the month, you take a look at it and you see what you spend. Now, if you're under 18 and you don't really pay any bills like that or whatever, it's still important to know in the future when you go to college, and you can, work on that right now with the little money that you do have. What do you spend the most on? Are you spending on subscriptions if you're doing that? Are you spending on eating out? Are you spending on clothes a lot? Are you spending on shoes? Yeah, you won't be spending on bills and stuff like that, but there are definitely things that if you have money, you're probably spending on. So keep track of it and know how much you're spending. So at the end of the month, and you get to review, ask yourself, was this purchase meaningful? Why did I make this purchase? Did I make it on the spot, or was it planned ahead? It's important to ask those questions because it's going to help you later on. This is when you make a budget. You're going to make a budget for things that you're spending on and things that you're saving. You're going to have a section for your fixed costs, which are your bills, things you're always going to be paying on a monthly basis, your investments, which we'll get to, your savings goals, which I'll talk about later, and extra money that you can spend on things. It's very important that you make a section for these spendings, because you don't want to feel guilty when you spend it, so you allocate that. Make sure you put everything in sections. You want to put it into sections so you know exactly what you're spending on where. Next, if you're like most people and you spend a lot and you don't know where the money goes, your first question is like, well, how do we save some more? This is my number 1 tip, and this has helped me save hundreds, if not thousands of dollars of the money that I do have. Wait. When you get that urge and you want to order something off Amazon, or you're feeling hungry and you want to order out, wait. Give it an hour, a couple of days, maybe a month. And after that waiting period, then you go back and you look into that and you ask yourself, do I actually need those shoes? If it's yes, then buy it, because you took the time to really think about it. And if you're still thinking about it now, might as well buy it. But if you stop thinking about it and you're like, I actually don't need it, then you might have just realized, you were gonna do some impulse spending. Another thing is to plan ahead of time. Have a budget. When you're going to the mall, you say, today I'm spending $100, and then you stick to it. Because a lot of times you end up spending money along the way. The money piles up here, 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 here. Next thing you know, you spent a whole bunch. So always plan ahead when you can. Another important thing with saving is to create emergency funds. The one main emergency fund will be a 3 to 6 month of your living expenses. Something you're gonna do when you're older, of course.
Got a little older. Yeah, I got a little older. My heart got colder.
But it's good to know now for the future. Another thing you want to do is make savings goals. So these are going to be Christmas. If you buy gifts for people on Christmas, don't wait until Christmas to start spending. Save money along, the 11 other months in the year, so that by the time Christmas comes, you already have money saved for that. You can also do this for if you have a car, when you have a car in the future, save for car fixture things. When you have a car, it might break down, stuff might happen. So save ahead instead of having it spring up on you. Next, you want to automate your finances. And this is an amazing method that I learned from this book, I Will Teach You to Be Rich, by Ramit Sethi. Don't know if I said his name right, but I'll be talking about that book later, and I'll probably link it up here when I finally post it. First, we're gonna go on definitions before I explain. A credit card is where you use the bank's money to buy for things, and then at the end of the month, you pay it back. A debit card
Debit card.
is when you use your own money from a checkings account to pay for things. Savings account is where you usually just put in money and you store it there. They do not have debit cards, but they do have things called ATM cards, which is a card that you take to an ATM to withdraw money. That's the only way you can use it. And then a brokerage account is one where you purchase investments. So you buy stocks, bonds, etc. And I'll be talking about these more in detail, like recommending different banks.
Excuse me, sir, we'd like to open our first bank account.
First timers?
Hooray!
In the future. If you don't have these accounts, it's okay. You don't have to open it up now, but if you're working and you have fixed expenses, you might want to do this. If you don't have fixed expenses, you don't need to automate just yet, but you can if you want to. With automating your finances, this is how it goes. You want to send all your money into your checkings account. Then from there, you want to have it automated that a certain percent or a certain amount will go into your savings account. So that's for your saving goals and your emergency fund. And then a certain amount will go into your brokerage account, which will be your investing account. But for now, I'd suggest from the research I've done that a good checkings account is Capital Bank. Good savings accounts are usually online banks because they don't have brick and mortar, which are physical buildings, so they have less to spend on, less staff, and they can be able to give you a higher interest rate. An interest rate that you get from a savings account is usually annual, and it's usually very small. So right now, a high savings interest rate is like 0.5%, which is nothing. But earlier on, before the pandemic, it was about 2.5, which is still very low. Some good investing accounts are Vanguard, Fidelity, Charles Schwab. Notice how I didn't say Robinhood. Last concept is to build your credit, and you're going to do this by buying a credit card. Now, since this is going to be your first card, you're probably going to be able to get a secured card, which is where you're going to have to put down some of your money and the bank will put down some of their money because they don't know what you're going to do with the money. So at least if you don't pay, they'll have some of your money. As soon as you turn 18, you want to get a credit card, and you're going to use this credit card to buy things you already purchased. Do not start purchasing new things just to use your credit card. Nope. You're going to use your credit card to pay for your phone bill and subscriptions that you do, your groceries, your gas, and make sure you get a card that gives cash back to get points for your purchases. A great card is the Discover It secured card, and this is really great for students, so get that card. Or you can find another similar one, do your own research, and make sure you're researching. Number one rule with credit cards: pay the money back. Pay the money back.
Pay the money back.
And pay the money back on time. Wait, notice how I said
Pay the money back.
on time. They usually have extremely high interest rates, way higher than your savings account. It's way higher than that 0.5. It's usually 5%, 8%, even higher. And it sounds a little bit, but trust me, do the math and it'll add up. Another thing, on time is very important. Don't pay it late because you'll get that late fee and you'll be charged extra on top of what you already have bought. Another important concept: buy what you can afford. Do not use your credit card because you don't have any money. Unless if it's an emergency. Honestly, it's probably not an emergency. So just don't do it at all, because when it's time to pay at the end of the month, you're not going to be able to pay. So make sure you're actually buying things that you afford on the credit card. Why is it important to build your credit? Because you get something called a credit score. And this is where banks are going to be able to rate your credit worthiness, if they can trust you with a loan. Another important thing is that when you have a good credit score, you won't get as high interest rates, because they know that you'll be able to pay them back and they'll get their money back in time. As opposed to if you have a bad credit score, they're like, you probably might not be able to pay this back, but they're going to increase your interest rate. So you're going to give us that money back in the interest. The way that credit is built is through paying on time, credit history, amount of credit lines open, and a couple of other things I'll put on here. But the highest thing is the amount of time you've had this card open. Since you've gotten your card at 18, you're probably going to want to hold it for the rest of your life, because it'll be a very, very long credit history that will boost your score for years to come. Build your credit. Be smart. You got this. Okay? You got the right money mindset. You know how to manage your money. Now you got to make money, right? You got to make money to be able to manage money, right? I want to be real with you guys. Number one way most people get their money is through their career. And even if you're going to end up, you want to have a job and then invest on the side, you need money to do it. So I'm not going to go too deep into this, but make sure you pick the right career for whatever lifestyle you want to live. Number two, side hustles. You don't want to rely on one job, because what if you get fired? What if something happens, a pandemic, and you lose your job? I'm not going to go too deep into this, but I'll give some examples. YouTube, of course, having an online store. You can also search it up on Google. Thanks. Another thing, most millionaires have, I think it's about 7 income streams. So make sure you have a lot of income streams if you want to be a millionaire.
I wanna be a billionaire, so bad. Buy all of the things I never had.
Everyone was waiting for investing. The number 8 wonder of the world is compound interest. A compound interest is where you're making money on the money that you're making money on. I'll give an example. You put $1,000 in a bank. You're getting 8% in interest. So that means you're making $1,000 plus 8% of that. And I'll have numbers up here. And then next year, you're making 8% on all of that. And that builds year on year on year on year. So even if you never added anything to that $1,000, you literally still be making money on it regardless. This is a very important concept, because an important thing about this is time. The earlier you have it start building, the longer the money accumulates. And this has been proven in like a study, like if you invest earlier with less amount of money, you make more than someone who invests later on in life with more money. I'll put something up here to show y'all. So as soon as you're 18, you open up that account and you start investing. Now with investing, there's different forms of investing. Of course, you have investing in gold, investing in the stock market, investing in cryptocurrency. But today we're just going to focus on the stock market, which is basically all companies in the United States or in other countries that you put your money in and you're helping them grow their business. For most people, it's easiest to just invest in an index fund. And an index fund is basically a basket filled with eggs. So instead of trying to pick the right egg, you just pick the basket and the right egg is somewhere in there. Now you're looking at me like, oh, but I want that egg. I want to fry that egg. I want to boil that egg. I want to eat that egg. I want to make an egg salad with that egg. And you know what? That sounds like a very great idea. But here's the thing. Editing me, and I forgot to include this, but basically 95% of professionals aren't able to beat the S&P 500 over a 15-year benchmark. So basically what that means is these are professionals who have like Bloomberg terminals, all types of different technologies, and access to information that you don't have. So if they have all that and they can't beat it, what makes you think you can? But if you're still curious and you want to learn more about investing and you think you can beat them, continue on and I'll give you some advice. So you need to do your research, and if you're not committed to that research, invest in index funds. It's the easiest way to get millions of dollars. And I'll put something on that in here, right here. Quick read. And we're like, okay, we want to learn about investing though. I'll get into that. Here are some important things to know before getting into investing. And if you guys want to learn some more, ask for it in the comment section, but this will just be a brief overview. Editing, hear me. Before you even do this, you want to first establish a plan and a goal. After you do that, you will pick your investing strategy and so on and so forth. Establishing the difference between investing and trading. Investing is when you buy a stock and you view it as a company. This is a company that you believe in, you believe they're going to grow or whatever, and you'll make money from that company. Trading, on the other hand, is where you literally just see it as a stock. You see it as less of a company, and you see it as one day it goes up, one day it goes down, and you want to buy it when it's down and sell it when it's up. Trading usually is buying and selling under a year, while investing is you're usually holding it for over a year. People will hold companies for 3, 4, 20 years to see the growth. Another thing to know is you don't have to just buy stocks. ETFs are baskets like the index funds. Both ETFs and index funds can be separated by sector, except value of the index fund is calculated at the end of the day. So you don't see it ticking up and down, and that really helps people to just buy it and forget about it. As opposed to ETFs, they kind of trade like stocks. You can see them move up and down during the day. Now, personally, I prefer ETFs under index funds because some index funds you need to have a minimum balance. So you need to have $3,000 to invest in it. So ETFs will be preferred for most younger people that want to diversify earlier because of the fact that they tend to have no minimum balance and pretty much just the same. So you usually see an index fund that can be also purchased as an ETF, vice versa. Here are some important things you need to know about investing. Buy low and sell high. And this sounds obvious, why would you want to sell low? You'll lose money, right? It's very important to take emotion out of investing. Important thing to know is to diversify. That's why you want to buy index funds and ETFs, because if you have only one stock, if you put all your money into Tesla and Tesla drops, you've lost all your money, my guy. Like you're done for. And lastly, you want to think about retirement. Right now you're like, what? I just turned an adult. Like, why am I thinking about when I'm older? Because of an important concept that we talked about earlier, compound interest. Because of compound interest, we want to start investing for later on, earlier, because it's going to build up. Remember? So here are just 2 of the many retirement accounts that you can open. So you have a Roth IRA, which is good to open up and invest in now, because you can invest, I think, about $6,000 a year, and the money that you make will not be taxed because you're using taxed money. Then a 401k, these are retirement accounts usually offered by your employer, and they will offer something called a 401k match. And this is basically where if you invest a certain amount, we'll match that with a certain percent back. So always invest enough to get the 401k match, because that is free money right there. And here are just a few important things to know with money. Do not let your lifestyle increase as you make more money. You don't just buy more expensive stuff, because if you do that, and it's called lifestyle creep, as you're making more money, you're spending more. So you're not actually able to save more. Live below your means. This is kind of like matching up with what I just said earlier. You don't want to be spending more than you make, and you don't want to be spending most of what you make. You want to be able to have some to save. Really try your best to avoid debt. You don't want to be owing anybody anything because of interest. Like we were saying with compound interest, it can work in your favor with investing, and it can work against you with these loans. Learn how to cook. The things that you find yourself buying outside and eating a lot, figure out how to make it at home. That's going to save you a whole bunch of money. Do not buy what you can't afford. So people have their different methods of calculating what they can afford, but it's like a general rule of thumb that if you can't pay for it all right there, you can't pay for that price times 2 or something like that, you probably shouldn't buy it. And lastly, take personal finance important, because you will always need money in life. The book I really advise you to read is this, I Will Teach You to Be Rich by Raymond Sethi. This book is amazing. If you want to learn everything about personal finance, but you don't got the time to go through different books and you just want to get it in one guide, that right there is the guide for you. I'll actually be doing a review or like book summary on it later on. So if you're just so lazy and you don't even want to read the book, I got you. On that note, make sure you hit the post notifications if you want to see more. Like the video, you drop your questions, your concerns in the comments. Look in the description for any links I might have put in there. And see you in the next video.